The Central Bank of Nigeria's Monetary Policy Committee, MPC, has increased the monetary policy rate MPR, which serves as the benchmark for interest rates from 24.75% to 26.25%. Governor of the CBN, Olayemi Cardozo, who doubles as the chairman of the MPC, disclosed the new interest rates at the end of the 295th MPC meeting, which was held on Monday and Tuesday in Abuja. This is the third increase since February. While speaking on the continued instability of the Nigerian currency, Cardozo said that it was a function of the free market system. We're joined this morning by emerging market financial analyst Ebuka Imebina. Good morning and thank you very much for joining us.
Good morning and happy to be here.
All right. This will be the third increase by the Central Bank of Nigeria and by the Monetary Policy Committee. What are your thoughts about this? Is this a positive move? Is this something to be very excited about?
I think in terms of whether you're excited about this, it depends on who you are and whether you have loans, existing loans, or planning to take loans, for example, from a financial institution. So for current holders of mortgage instruments or any other form of short-term borrowing or long-term borrowing, they will definitely have to pay higher interest on their loans. In terms of the impact on inflation, which is the primary objective for which we are seeing this increase, I think over time, like you mentioned, this is the third increase in over the last few meetings. And it must be emphasized that month on month, there's been a decline in inflation rates. But year on year, we haven't seen a commensurate decline in inflation rates, which is why we're seeing this increase in the prime lending rate from the central bank. So in terms of how does this impact, the primary objective, which is inflation? The central bank's primary function is price stability and also full employment. And so in a desire to achieve that price stability, we are seeing these responses from the monetary authorities. However, the extent to which, like I mentioned, to which this would actually then dovetail into prices is what we do not know. However, I must say that the primary role of the central bank, which you mentioned as price stability and full employment, I listened to the CBN governor's announcement, of this increase from the committee, and I was actually surprised that I didn't get any head up on the employment rates. So usually when interest rates are raised, the primary impact you want to see would be firms begin to, it's usually to reduce demand. So you want to see reduce demand on the consumer side, and then you also want to see some measure of supply restriction from firms, and that usually translates into the rate of employment. So firms begin to kind of sort of slow down on their operations. And so I didn't hear any questions. I didn't hear any responses on unemployment. And so, one begins to really ask, to what extent do we think that these rates increases are impacting firms, impacting ordinary people? And then to what extent do we think that they would actually go in achieving their purpose?
All right. While we do understand that, the CBN is actually at war now with the economy. It's much more like it's a battlefield. So the CBN is trying all it can to ensure that it stabilizes the economy and that there wouldn't be any form of inflation, especially looking at the fact that food items can at least come down to a very, very minimal, so that everybody, all Nigerians will be able to feed. But I'm worried, and my worry is what I would like to ask to you. What happens to those who had taken loans before a review of this interest rates? Now, whether they like it or not, it's usually known that there will be a review in the rates, in the prices, in the costs rather. There'll be a review so that the loans that were taken can actually match the new interest rates of what the CBN has actually brought out, which was yesterday. So if I took a loan And I'm worried right now. What can you say about this? And did the CBN miss this in line with trying to ensure they stabilize the economy? What's the role? What's the future? What's the hope for those who took loans?
Yeah, very good question, I must say. However, when you look at an economy, it's you looked at as a whole system, not just one part of it in isolation. Yes, and so when I listened to the CBN governor's address again, and he did mention the increase in food inflation over time, and that being a primary cause, and mentioned factors such as insecurity, imports, exchange rate transmission, and all of that. For me, if you ask me, I see these increases as having a dual function. There's the objective to equally impact exchange rates while also being able to have an impact on inflation. But like I said earlier, when you look at this, you have to look at it holistically. It's a system. And if you're looking at that system, the monetary authorities also need to look at how some of their own policies have actually resulted in this runaway inflation which we are currently having. And I'll look at the money supply, for example, the broad money supply. It has increased to as high as 92 trillion, according to the central bank's own records in March 2024, from 56 trillion in a similar period in April 2023. So in about a 1 year period, we've seen more than a doubling of broad money supply. And, action then needs to be taken to actually mop up some of this. We saw the CRR, which is the cash reserve ratio, remaining unchanged. I would have expected an increase in that. Where I'm going really is that, a lot of the inflation which we see in our economy, the Nigerian economy, it's not necessarily driven by excess consumer demand. You look at money in circulation, it's not necessarily with the commercial institutions. So it's more, a lot of it is, money, increased demand deposits, So generally, we need to look at the economy from a more holistic perspective. To address your question in particular, around interest rates, it must be said that this will definitely impact the cost of production for firms, and I would expect them to transmit it to consumers. And so what that means is people would likely want to spend less. People will be thinking about, servicing their loans, increased cost of basic food items and all of that. So there has to be a push on the fiscal side to actually cushion some of these effects on the ordinary man, the ordinary Nigerian.
How effective would this new move, would it be to target food inflation? We know that food inflation currently stands at over 40%. And there are many who would argue that the driver of the food inflation would be setting other criteria. For example, we have insecurity, which is at an all-time high, according to some of the reports that we see. I mean, it's worse than it's been in a long time. So there are those who argue that this might not really do much to be able to target or deal with food inflation. I'd like to find out what your thoughts are on that.
Yes, I would say that if you look at Nigeria, is not a standalone emerging economy. We are in a world of, if you look at the global economy, we are similar. The situations which we face is similar to what you have in so many other countries. And so if you take a walk back into the past, you find out that countries like Brazil, for example, had started increasing rates in order to tackle inflation. You had global inflation from the coronavirus, the pandemic. You had a lot of money being put into circulation across the world, and then you had supply chain bottlenecks, and all of that caused rising inflation, which in the developed world they are still trying to tackle. So if you looked at the actions of central banks in other countries, similar developing markets, you find out that they began to raise interest rates much more earlier than we have done. And so for us, our own response is a little bit late. But the way I would look at it is you still have to do what you have to do. And so what you could have done before is probably what you're doing now. But like they say, better late than never. So this is an inevitable action. I've been on your program before, and I did mention then that this was the single missing piece if you look at it from a textbook perspective, this was still the single missing piece at that time from the CBN's policy responses. And so this is a necessary medicine in order to tackle the inflation rate. But the impact on economic growth, is something that must be considered. And I do not know the extent to which that has been fully thought out, but it needs to be the impact on the productive sector, needs to be very, very well thought out. Again, I must say that if you look at some of the actions which are necessary over time, inflation is usually persistent, even in developed economies, and similar to the actions which we have in our own economy. Inflation is usually very persistent and takes at least a 3 to 5 year window to actually begin to turn around. And so the permutation for Nigeria, we have an inflation target of I think 10%, and currently from the April figures is 33.69%, so way above. If you look at the policy rates, which has just been released, is 26%, so it's still even below the inflationary level. What that means is that real interest rates are not market reflective. Again, central banks, monetary authorities, are not necessarily the best at forecasting inflation. They're not necessarily the best. Rates really are a market perspective. Rates are a market phenomenon. And if you want to see the outlook for rates, I think you should look at what's happening in the market, what's happening in the bond market, the fixed income market. And that tells you what the perception, what the market perception of rates really would be. So the central bank is trying their best within their own limits of authority. The actions which we are taking now, I think, are actions which should have been taken in the past. But again, the central bank in this existing regime did inherit a difficult situation. Interest rates, real interest rates are still negative, and so to what extent does this really solve the problem? Do we think that we're going to see higher interest rates in the short term? There's a possibility for that, and that's largely because we have taken action a little too late.
All right. You've broken it down. In other words, if I'm to sum up the points that you've made, it's an action that ought to have been taken earlier. They should have done this since. And you're saying it's going to take at least between now and 5 years for the inflation to come down. We've seen a similar situation in the UK, where the inflation rate in the UK is starting to really to come down. But I'd like us to translate it to the common man on the streets. We do understand that in all of this, one of the beneficiaries of the monetary policy, so to say, are those who have monies in the bank, because they're going to have a lot of interest on their savings right now, especially now that the interest rate has gone up. It means if I have money, XYZ amount, like 100,000 naira in the bank, the rates that I would get in terms of interest rates of my money would actually go up. But how does this affect the common man? How does this affect the price of bread, the price of beans, which is to be used to make akara? The price of groundnut oil. Do recall that we're not a producing state, we're rather a consumption. We're known for consumption. So can you break this down for us? It's also good that we know the truth, the likelihood of not just having one beneficiary, which is if I have money in the bank. What about those who don't have money in the bank?
Yeah, very good question. Again, I'll look at it again from a finance perspective. Inflation rates as high as 33%. So what that means is if you borrow from a bank today, within 2 years, you would actually have paid back as much as double of what you borrowed in principal and interest using the rule of 72. So within 2 years, you would have actually you'll be paying back almost twice what you borrowed. And now that's for a person who is trying to do business, productive business. And what about a person who says, okay, I have money in the bank? If you have money in the bank, the real value of what you have, considering inflation, is actually also running down. Within 2 years, you are actually losing as much as 100% of the value of what you have if the current inflation rate persists, which we've said that Nigeria has an inflation target of 10%. The probability that we get back there, is actually very, very minimal within the next 3 to 5 years. And so the impact of this is, the average person is in a dilemma. For what I receive, do I spend it now, or does it really make sense for me to save? And then if I'm trying to even spend it now, to what extent does it actually meet my needs in terms of my purchasing power ability? I listened to your news roundup where you talked about the minimum wage. I would have expected that, again, if we're looking at the impact on the ordinary person, I would have expected that with the fuel subsidy removals and all of that, the move to a flexible exchange rate, what that meant was that the government revenues have actually, as much as significantly increased over time, and some of those increases have not been passed on to workers. And so when you have that, but again, remember that when you have that, then you continue to have that spiral of inflation, because it means that people then have more money to spend, and then it continues as a spiral.
Right.
And so, perhaps the way the government is looking at this is that, the real wage, they're trying to restrict the real wage, the actual purchasing power of people, so that at the end of the day, the inflation itself is actually a tax.
All right.
On the common man.
Ebuka Emebina, thank you so much for joining us this morning. It's been a pleasure having you.
Thank you so much.